almost invisible detail can destroy the value of a home. It doesn't appear in the listing. It doesn't appear during the visit. But when you find out, it's already too late. The real problem isn't the property's price. The risk lies in ignoring the hidden defects of the location. Defects that require a rigorous technical inspection and extra cash for emergencies. If you're buying with the future in mind, this detail matters. It's not just about square meters. As Gaston Bachelard observed, houses are not just physical structures, but systems of memory, risk, and permanence. It's about liquidity and capital preservation. Properties on arterial roads seem practical. In practice, they have a much higher exit barrier. The market punishes the low liquidity of these assets. The economist Hyman Minsky reminded us that the apparent stability of markets often hides risks that only appear when everyone tries to exit at the same time. And what if you're near high-voltage power lines? It's not just a visual issue. The banking sector imposes severe restrictions on mortgage credit in these zones. Having train tracks in your backyard doesn't bring charm. It brings constant mechanical stress to the foundation. Silent vibrations assault the structure year after year. Neighboring commercial lots? They drain the value of your residential asset. Sloping land is another money pit. A structural engineer I spoke with during a property renovation in New York told me something I've never forgotten. Gravity never negotiates with the budget. They require recurring maintenance on retaining walls, costs that never appear in the sale listing. Seawater accumulated at the foundation? In the first house I visited to buy, the agent called it normal moisture. The engineer I brought on the second visit called it a future legal problem. It's not just moisture. It's a clear sign of drainage failure or flood-prone soil. And if you need to replace the septic system, get ready to shell out between 20 and 30,000 monetary units. Provisioning capital for contingencies is not optional. Isaac Newton himself learned this in the most expensive way possible when he lost a large part of his fortune in the South Sea Company bubble of 1720. I can calculate the motion of heavenly bodies, but not the madness of people. It's the difference between an investment and a nightmare. Now, let's look at the scenario in Canberra. The situation in Australia is a global warning. It's not a passing crisis, but a systemic misalignment. In the 90s, a plot of land in Tokyo was once worth more than all of California. The Japanese bubble didn't end well. Around the middle of last year, the region entered a per capita recession. This has happened only 3 times in the last 4 decades. The result? Real wages have returned to what they were nearly 15 years ago. Meanwhile, data from the Australian Institute of Health and Welfare shows that house prices in the capitals have skyrocketed. Since the early 70s, the value has jumped more than 35 times. The largest metropolis on the East Coast is now almost prohibitive. It is the second most expensive market on the entire planet. In some cases, debt service consumes practically half of every gross dollar the worker earns. Think about it. A property that cost $500,000 in the early 90s. Today, it is valued at almost $2.5 million. Those born after that time are out of the game. And who dominates the stock? The investors. They hold 2 out of every 5 houses in the total market. The system encourages this with deductions for investment losses, and it also offers discounts of half the capital gains tax. The local central bank didn't stand still. There were more than 10 interest rate hikes since mid-2022, according to the Reserve Bank of Australia. But the supply deficit continues. About 100,000 units per year are missing to balance the account, according to the National Housing Supply Council. With the arrival of more than 500,000 new residents last year, the vacancy rate stalled at around 1%, according to CoreLogic Australia. The curious part? There is one empty house for every 10 existing units. The mismatch between income and housing is not a scare. It's an almost insurmountable barrier to entry, bringing the focus to Ottawa. The dream of the North is changing color. Canada faces a worrying structural disinvestment. Since the middle of the last decade, the energy sector has lost $60 billion in annual investments. Technology, which should be the future, is stagnant. The GDP of this sector hasn't grown in real terms for almost a decade. This generates an immediate side effect: the brain drain to the southern neighbor. About 10,000 residents leave the country annually for the United States. Why do they go? There, salaries are higher and the cost of living is lower. In Ottawa, property values have reached record highs, according to the Canadian Real Estate Association, but the real economy hasn't kept up. Food bank use has soared among local residents, according to Food Banks Canada. Even immigrants are leaving in unprecedented numbers. Capital and talent are not just looking for promises. They seek efficiency and return. When the cost of living surpasses the ability to generate wealth, the result is not growth, but evasion. Government incentives for industry aren't working. It's not a problem of lack of will, it's a statistical and execution failure. The Canadian real estate market is no longer a safe haven. It has become a test of financial survival. Keep an eye on the data, not the narrative, because real profit requires clarity on where the money is fleeing. The global market is changing the rules while many are still playing with the old manual. As Nassim Taleb reminds us, the greatest risk is usually the one no one is looking at. If your goal is capital preservation and not just speculation, technical knowledge is your only real protection. Subscribe to the channel to receive these in-depth analyses and leave in the comments which of these markets, Canberra or Ottawa, surprised you the most today.